Hello and welcome to BQ Prime, and you're watching Earnings with BQ, and joining me is my colleague Monal Sangvi, and joining us today is LUPIN'S management, Ramesh Swaminathan, who's the CFO at LUPIN. Ramesh, thank you very much for joining us on BQ Prime. To begin with, you got a good set of numbers with top line growing at nearly 12%. What was the triggers in this quarter for you?
At the outset, of course, thank you for having us on. I would actually say it's a refreshing set of numbers because in the recent past, we've had, of course, some lackluster sets. So to the extent, I hope that it is actually the beginning of good things to come. It's actually been a combination of, in fact, good growth across several markets, and of course, a lot of the initiatives that we have taken in recent times on the cost front really paying off. To be specific, when you talk about the cost, because I think that is really clearly visible. We spoke about, in fact, several optimization measures in terms of inefficiencies that have crept into the system over time. A lot of those actually have paid rich dividends. For example, along the gross margins line itself, there were inefficiencies, as in the case of air freighting of stuff into America, on the write-offs and on the returns front. A lot of them got addressed during the last several quarters, and of course there's more stuff to be done there as well. Apart from that, we also rationalized on, in fact, workforce across the manufacturing, R&D, and other functions, and that's clearly visible when it comes to manpower costs. It's risen by only 3% year on year. There has been good work done across, in fact, the SG&A front as well. But unfortunately, there's of course been a step up in terms of sales and promotion expenses, which is absolutely required when it comes to, in fact, the markets like India, the adjacency businesses, and the like. In a general sense, when you speak about the gross margins itself, things could have been much better, but for, in fact, secular inflation that seems to have plagued all industries, and our company has also been it's not as though it's immune to that. It was really about 5% of inflation. The other factor which played down, in fact, the progress on the cost front is essentially the translation impact of forex. The forex rates have kind of gone up. In recent times, it was about 75 last year. It's now about 82, and that has, of course, impacted, in fact, the translation of cost lines. And when you speak about markets, we've done pretty well across the entire other markets also. India has, of course, done well vis-a-vis the previous year, though, of course, in a general sense, we were impacted by loss of exclusivity on the diabetes front, at least for one therapy. And that's, of course, will get addressed over time. When you speak about other markets like Philippines, South Africa, Brazil, done pretty well with, in fact, newer products and the like. The acquisition in Australia has also, of course, come pretty good. America is doing a good steady $175, $180 million. So all of this, of course, have contributed to a fairly refreshing set, as I said. And we are fairly optimistic about the future in terms of things becoming better in the quarters to come, both from a top line perspective because of the cashier products that have kind of lined up, and of course on the cost front as well, where the initiatives will still continue.
So is it then safe to assume that we are heading towards the 17-18% guidance that you had given for the Q4? We're at 13% right now. So is that the expectation for FY24?
I would correct you saying that this quarter we actually 14.3%. So you perhaps are excluding the other operating income, which I think is also would be sustainable because it is actually PLI income. In terms of these incentive schemes granted by the government, highly sustainable. Yes, you're right when you speak about the fact that we are heading towards the 18% mark and beyond. Clearly, we believe that the successive quarters would see better results, and we could end the year with the rates that you kind of speak about.
When do you see that mark coming in, 17 to 18% EBITDA margin? Will it be from Q1, or it will take a couple of quarters to gradually go up?
It is going to be progressive. Progressively it's going to get better. Towards the end of the fiscal, we would see, in fact, north of 18% is our anticipation, provided, of course, the products that we're speaking about come into the market, get launched. and of course the cost initiatives go the way we kind of plan it.
Ramesh, one question on R&D actually. You're spending one of the players in the market who is spending a huge proportion of this sales on R&D. 7% in Q4. If you look at overall FY23, around 7.9%, 1,200 odd crores you're spending on R&D. Can you give us a color of what kind of spend, where is it going, what kind of molecules you're working on, and when do we see return on this investment which is going on?
So three things to comment insofar as the R&D spends is concerned. As you can see, as a percentage of sales, it's been going down over the last 3 years. We are actually kind of, the emphasis today is on more complex products across inhalations, injectable space, specialty products and the like and so on. So that's the first step. So essentially we are, pruning down expenditure on what we think are more intense areas like oral solid dosages, or for that matter, pruning down on, in fact, the kind of spends that we had on the NCE front. But we are certainly stepping up the gas on inhalations, injectables, and more complex ones. So that would certainly go going forward. That would be the way it is. So more pivoting towards, in fact, more complex generics, whilst coming down on the plain vanilla generic stuff, oral solid dosage stuff, and the like.
My question was from a point of view that you're spending a huge amount, even though percentage of revenue may be coming down, it's still 1,200 crores, which is huge. And is there internal metrics of how you look at the returns from this kind of investment into R&D?
Yes. Yes, for sure. It's always return on investment is what we actually look at when it comes to any kind of spends, and for sure R&D it deserves a lot more focus than anything else for that matter. We see it as an investment for the future, and we actually calibrate, in fact, in our allocation for this, because it is really what we really measure. A lot of this complex generic stuff that we are speaking about would have a lower intensity of competition, and to that extent we believe that the prospects for each of those drugs, each of those molecules out there is far superior to what we can get, at least in the recent past, so to speak. Some of those spins in the recent past have been stymied for the fact that we couldn't actually launch some of those products because of OAI status among some of our plants, but that's the past. So we are really talking about the future, and our spends are also pivoting towards more complex, which we believe will pay off big time.
So where are we on the Spiriva launch? I believe that was expected the last quarter.
We have been guiding towards this towards the first towards the end of the first quarter. So June, July is when we think the launch would be. It's a big one, and we're all anticipating this would come through.
Sir, any update on the Pithampur facility, the inspection of when it is scheduled?
The facility, of course, has been is being inspected. So we are, in fact, we are still confident that all our OAI status factories will get resolved because there's a lot of emphasis on getting this off the block.
Also, sir, any update on Mandideep and Tarapur? I believe Nagpur has been cleared. So these two are the ones that are still awaiting.
As I said, we are hopeful about our prospects for all our plants. There's tremendous focus on, in fact, getting our FDA, getting right by the FDA for all our plants.
Ramesh, if you look at the US portfolio, you launched one product in Q4. Can you give us an idea of how that's performing? And can you also provide us, since you're one of the largest players there, and third largest, I would say, what's the kind of pricing environment that you see? Because last year we saw a huge amount of pressure coming on pricing. Are you seeing that ebbing now? How is it working for you?
Yeah, the intensity of competition is as it was. But having said that, I would say prices are really kind of stabilizing. Erosion is around the high single-digit mark, so to speak, across market, and it really is actually a function of the kind of product that we have. Speaking about, in fact, performance of individual products, we are pretty pleased with, in fact, the way things have developed for products that we launched in recent times. Suprep, for example, is now the third largest product in our portfolio, continuing to do well. Our inhalations portfolio continues to do well, and we are, equally confident about potentially the products that we are going to launch in the quarters to come.
So on the API bulk drugs front, we have seen a 46% rise. So what have we done so differently, and are we expecting to see this sustain?
If we talk about cephalosporin products, the market was virtually absent in the last couple of years because of COVID. Nobody was kind of venturing out. Acute therapy was not picking up in any part of the globe. Things are bouncing back slowly. So products like Cefaclor, 7-ACCA, we are doing well there, and so that gives us a lot of scope for optimism.
On the formulations front, you saw 10% growth there. How do you see the growth going into 23 for that segment?
We see, in fact, high double-digit numbers across the entire company. So we are pretty buoyant about our performance prospects in America, and equally in other markets as well. So if we speak about Europe, there is a ramping up of Foster itself, Camuscla, and of course other parts of the Tiotropium launch and so on. There's of course buoyancy across various emerging markets. The acquisition in Brazil, Paloma, is doing fairly well. There we also have, in fact, newer products lined up across various markets. Philippines continues to do well. There is, of course, South Africa, which did particularly well this particular quarter. So there is, all-round optimism when it comes to, in fact, all markets insofar as we are concerned.
Finally, Ramesh, you spoke about it a little earlier, about the currency rates, because last year Q4 it was around 75. Today, this quarter it was 82. So a lot of translation revenue jump is also on account of the translation in currency. What about the volume growth? Are you seeing enough volume growth as well?
Yes, there is of course volume growth across all our emerging markets, including India. So there is of course a mixture of volume growth and price growth in other markets as well. In some ways, when it comes to, in fact, the iron markets like America, it's always volatile because prices erosion. It's steady right now, but you never can say how long it is going to be like that, and so on. So under the overall circumstances of volatility, you would expect prices to be across markets to behave differently. The branded markets, there is, in fact, in some ways, price stability. In, of course, the iron markets, one could be less sure about that. But overall, today it looks pretty steady.
So, how has the tax rate been this quarter? Is it lower than the usual?
So essentially, insofar as India is concerned, we are at the lowest possible rates in India. It's not as we are mad, but it's a very it's lower than the company average. This particular quarter, the overall tax rates were lower because we had anticipated certain income into the fourth quarter, which did not materialize, and so we kind of provided for in the previous quarters in some ways, which kind of reversed out because of the accounting treatment on the targeting the effective tax rate for the full year. Given the fact that we believe a lot of the loss-making subsidiaries, Brazil and America, to kind of flag off, would turn to be to the positive. You would actually find that the tax rates to kind of mellow down, and going forward between about 28% is what we think is going to be the effective tax rate for the company.
And so my last question is on expansion plans. Recently you did the Medisol acquisition, which is into injectables. So is it, how is the plan for expansion going to be? Is it going to be more towards injectables, generic injectables? Are you looking at more specialty products? Can you just give us some idea of what's in store?
We would like to be opportunistic based again on the proposition itself. Medisol, of course, sets us up pretty well for a foray into France. So potentially, it's in the injectable space, as you correctly flagged off. And given the fact that we are also kind of focusing on our injectables portfolio across various markets, this is the perfect background for launch of the portfolio, in France, at the time that we actually bring it to markets.
It was a pleasure talking to you today. Thank you very much for joining us on BQ Prime.
Thank you very much. It's always been a pleasure.